So thanks so much for joining us for the Seattle Angel Conference Workshop Series. We're doing this as a runner-up to the Seattle Angel Conference number 21 with the deadline for companies applying February 24th. Our goal with this is to grow new angel investors. So we have people here who are part of that SAC 21 as investors. We have others that are part of this as companies. We'd like to know who's who. So if you are an existing angel investor in one of our programs, could you raise your hands on the participants list just so that everybody can sort of see who's here? Cool. So I know Alex and John Dex and so forth. So John Dex, while we're waiting for the votes, would you do a little tiny introduction?
Sure. Yeah, I'm the manager for SAC 21, Seattle Angel Conference 21st edition. That's kicking off March 1st. We have a few investor slots left, so if people are interested, reach out. We have plenty of founder slots available, and also same thing. Feel free to register or reach out to me if you have an interest. I'll put my contact information in the chat, and feel free to follow up directly with me if you'd like to join SAC. And by the way, Karen, welcome. Really looking forward to your presentation today. Nice to see you again.
Yeah, nice to see you. Thanks, John.
Cool. Thank you so very much. If all of you folks would lower your hands, and then anybody who is a company that's seeking outside funding and starting to look at this, please raise your hand. Cool. And so presumably that's supposed to cover everyone, but I'm sure it doesn't. How many people are here just because they want, please lower your hands now. And those that are here just to learn, because whatever this thing is that is angel investing is interesting or early stage, raise your hand if you're here just to learn. Cool. All right. Well, thanks so very much. That'll help us tune the conversation in the right place. Our program, the Angel Conference program, tries to get people to go from being accredited but not investing to having done an investment to having joined a group and done many investments to becoming a fund manager. And one of the people that exemplifies that journey is Karen. She joined us on the program as an early investor, has gone through several times, and now is a partner at First Row Partners, which apparently all of the partners are not only alumni of SAC, but women who were in SAC. And so we also have this goal of having a broad range of diverse participants. So this has been a double plus success story here. Karen, I'll let you take it away, and
all right.
We'll come back. If people have questions, have them put things into the chat.
Okay, perfect. And I'm gonna actually share my screen. So let me do that. Tell me if you can see that.
Yeah, it looks great.
Okay, perfect. Great. Well, welcome. Thank you for having me. I'm excited to be here. As John mentioned, I'm very familiar with SAC. I've participated in 4 rounds, I believe. So one wasn't enough. I think you could continue doing it. You don't have to be a new investor to participate in the process, because there's some amazing companies that come through that. And so I know that there's a number that are represented here. I'm happy that John did that, because this was going to be one of my slides, was trying to get a feel for who's in the audience. I've tried to make this presentation applicable to both aspiring investors, existing investors, and founders as well. So hopefully we'll cover it. And just a little bit about me, as John mentioned, I have done this kind of path through my career where I was working full-time when I was doing SAC with an industrial biotech company, actually in the clean tech space. And so I was working on SAC, and then I joined a couple angel groups. One was Grubstakes, and then another was E8, which was focused on the clean tech sector. And then I also ended up joining a couple funds. And then now I've made the full transition to not working full-time, except for working full-time in investing. So I'm a partner at First Row Partners. And First Row Partners, for those of you who don't know us, we're a pre-seed VC fund that invests in enablement technologies for creators and emerging enterprises, kind of API first, no code, low code companies, marketplaces, and creator tools. So that's a little bit about me, and I'm excited to be here. So a little bit about what we're going to cover today. It's a lot, because it's kind of like we're scanning over the whole early investing process, early stage investing process. And so I know John has and Elizabeth and the rest of the team have an amazing programming set up. So my guess is some of the topics we cover, they'll have in-depth sessions on. So just stay tuned and watch what programming is coming up, because I'm sure there's like a due diligence session and all sorts of good stuff. So we'll try and give a really good scan overview, and then hopefully we can dig in areas people are more interested. My big disclaimer, this is not investing advice. It's a point of view that I've developed across my experience, and then also some from First Row as well. So it's designed really just to be learning and sharing information together. So what is early stage investing? I think it's helpful when thinking about early stage investing to just kind of get the big picture in mind and think about, how many stages a company goes through in terms of milestones and raising money and risk and de-risking things as you go along the path. Early stage investing is, when people and companies provide funding to companies at the very earliest stages of companies' founding. And that means maybe there's an idea, maybe there's a minimum viable product, maybe you have a full-blown product even sometimes. Maybe there's some early traction, maybe there's not, maybe you kind of have a feel for product market fit. It's especially important for the team, for investors looking at these early stage things to understand who the team is and why they're the right ones to be doing this. And groups that are kind of investing in this phase, there's a number of groups that invest in this phase. Accelerators, which are programs that help startups kind of accelerate their development. And then they take potentially an equity stake at the end, or some sort of, they provide funding. It all depends on what the structure of the accelerator program is. Friends and family will invest at this earliest stage. Angels will invest at this earliest stage, and those are individuals. And then there's pre-seed VCs and microfunds that we've seen more and more come about. But the things that I think would be important to kind of take away, particularly about this stage of investing, is that it is risky. It's definitely risky. And your investments at this stage also have a long time horizon to a liquidity event. So they're very illiquid. The time it takes for a company to get to a merger acquisition or an IPO is a long period of time. So just keep in mind that if you're thinking about this, that it's not something you're going to be able to cash in tomorrow. So if it's so risky, why do investors invest? Well, I think you probably imagine that there's an idea about the return, that high risk many times means that there could be a high return. So there's the potential for this high return. This chart, which is on the slide here, is a little bit outdated. It's from the Angel Resource Institute, but it is very representative of what return expectations can be for an angel portfolio. And so I think it's reasonable to expect that you would get a IRR of about 20%, especially if you consider how to balance your portfolio and build an angel portfolio to maximize that potential return. I think the thing to consider here is that failure rates for startups are pretty high. And so if you have a portfolio of investments, you can expect that 60 to 70% of your investments will fail or cease to exist. So you have to really think about the structure of your portfolio to target that higher return. The other thing I would mention here is that angel investments are typically uncorrelated with the market. So it's another way that you can kind of think about how to balance your portfolio overall, right? And so something just to consider that I think is a benefit, certainly a benefit that I saw. But I will say it's not just about returns. I think there's a lot of benefits that you'll find in angel investing, and for me, it's a factor of all of these things. And the reason I've chosen to do it, full time is because of a lot of these things. I think there's one key thing for me, which is that where I choose to put my money is where I'm making an impact. So that could be that I'm passionate about clean tech. So as I put my money in clean tech, I know I'm going to be making an impact on climate change. Or it could be that I want to empower a certain group of people that haven't had the ability to do something before. So by me putting my personal money behind that, you're in essence making that impact, or impact investing to a certain degree. So I think that that's an exciting piece to me, is really putting my money to work where I see where my values are represented. Another piece that I think we all have experienced is I want to be constantly learning, and this is an opportunity to do that. I don't think there's a day that goes by that I'm not learning something new, whether it's about an industry or a company or meeting someone incredibly exciting. And I think that this space in particular, the people are just so passionate, and that I love about it. So there's so much more than returns that's involved in this. And I just want to make sure that we think about that and as you go forward. So who can invest? Well, we'll start with what's an angel investor. So until I studied entrepreneurship, I thought investing in startups was just something that venture capitalists did. It's kind of this elusive opportunity to get involved. And I didn't know what accreditation was, or that it was something that I could get involved with. And I know Elizabeth threw up a stat on LinkedIn recently that I can't remember what the stat was, but it was an amazing stat that most people who are accredited don't know it, and don't know that they can actually invest in as an angel investor. And an angel investor is really just an individual who can invest in a new or small business. So when we hear about angel investing in the media, we're typically talking about investing in venture scale businesses. And venture scale meaning companies that can scale quickly, size, valuation, and you can capture kind of billions of addressable market. But I should mention that I think when you're considering it as an angel, you're not only limited to venture scale, you can invest in all sorts of businesses. It just, the return profile might be different, or the trajectory of the company might be different, but you have flexibility in what you can invest in. So, but for the purposes of this discussion, I'm really focused on kind of that venture scale side of investing. So based on the audience, I think, there's certainly a number of already investors, some people that are learning, and then some founders. So we're on the same page, just to understand kind of specifics of what makes an angel investor accredited. These are the kind of requirements. And on this slide, you can see these three things. It doesn't have to be all three. It can just be one of the three. It's self-declared. You don't have to sign some form or do anything. It's really a self-declared, being accredited as self-declared. And I would say that there is a new act that I think was enacted in 2012 that has allowed people that don't meet these requirements to invest, and that's through things like crowdfunding platforms. And I'm not going to be talking about that here, but I will say that there's a ton of different activity happening in that space right now. So if that's an interest and you're not quite at this level where you're accredited and you're interested in investing, something to check out for sure, because there's a lot of really interesting opportunities there. To balance that, I just want to talk a little bit about what a venture capitalist is. It's basically a private equity investor that's providing capital to companies that have that high growth potential. And a little bit about the structure, just so give you everybody a framework of how they work. You have a venture capital firm, which typically has general partners or general partner, and they pool funds from limited partners, LPs, that goes into the venture capital fund. And they also pool their own money many times and most of the time as well. And then they manage that fund and they make the decisions of what those investments might be. So hopefully this kind of gives a good picture of kind of how that process works, at least a quick overview. And I would say that the one thing to keep in mind is that venture firms have a fiduciary responsibility to the investors, and they really are aiming to produce strong returns over that, typically a 10-year timeframe. And LPs are made up of accredited investors, family offices, pension funds, foundations, all sorts of different groups of people that can invest in a venture capital fund. So some differences between kind of the angel and VC side. I think angels have a little more flexibility in terms of what they're investing in. It's a personal choice. Angel checks are going to be typically smaller, right? And not necessarily, if you're a very wealthy individual, you might be making the same size investment as a venture capital firm. But typically, VCs are going to be very strategic within a very limited focus or investment thesis. There's some funds that are generalists, but in general, there's a kind of an area of focus that VCs we focus on, and then they invest a larger amount into a startup, and they're targeting specific range of ownership. And so I think that there's just some subtle differences to think about when you think about the two different groups. And please feel free to interrupt me if there's questions or things as we go along, because otherwise it's a lot of me talking. But how and where do I invest? So this one's kind of a interesting piece for me, because I think when I first got started, I made one angel investment, which was probably, I had one angel investment previous to SAC, and I didn't really think about it. And then I was like, gosh, well, how do I actually look at this? Because, if you want to maximize that opportunity, there's some intentionality that you can put behind it. So this graph right here kind of demonstrates that the more investments you have, the more likely that you'll have a better return. And I know from my SAC days that, John, I think you say 20 investments is the kind of like the number that we kind of look towards. And
the longer I do this, the more I begin to believe that that's like a bare minimum, and that you really want to have closer to 40.
Yeah, exactly. So, I mean, I don't know actually what date this graph is from, but it'd be interesting to kind of see where it's evolved from the time that it was originally produced. But it's important to think about, how you put a portfolio of 20 to 40 companies together. So thinking about your assets and what you wanted to allocate towards that, and how you might get to that 20 to 40 number. And so, for simplicity's sake, say you have 5 million in investable assets and you allocate 100K a year for early stage investments. In Seattle, a typical direct investment is 25K or so. And if you choose to invest in those companies directly, you'd be able to invest in 20 companies over 5 years. So, but maybe you don't want to invest that much. Maybe you want to invest 50K. How are you going to get to those numbers? So I think it's just important to really try and be intentional about how you build a portfolio to try and maximize the opportunity. So I think when you're looking at how you build a portfolio, another area to consider, it's not just numbers, but it's also how long you're investing, over what time frame, because as we all know, there are major world events that impact the economy and startups in particular. So, thinking about try and invest over a broader period of years so that you get that kind of balance again. So if one year everything tanks and nobody's spending any money and they're, whatever it might be, you don't get hit completely because you haven't invested over a number of years. Sectors as well. I mean, I think it's important to think about, if you say you did all your angel investing in crypto, you might become a billionaire. I mean, it might be the best thing you've ever done, but you might not. So, trying to diversify what sectors you're involved in. And I would say that, one thing that has been proven is that if you have a lot of experience in a particular area, you probably will fare a little bit better if you invest in it. It's just that sector that you have insight into. So, I mean, you just try and be balanced, I think, is the general thing there. And then geography is another thing to consider. Is, do you want to have exposure to different markets? Different things are happening across the world. And, when you're making these investments, do you want to have deals that have slightly better deal economics because they're in the Midwest, and this is changing as the advent of Zoom deals and such are happening. But so terms are starting to even out a little bit, but just trying to think about where can you get better deal economics? Are there other geographies you want to have exposure to that might have different reactions to the market? So some areas just to think about as you start to build a portfolio. So this slide, it's a big one, and you could spend time on all of these categories. And since I have worked across all of these groups and still work across many of them, I tend to get carried away. So I'm going to try and keep it brief, but just want to give a little overview of what all the different ways that you might be able to either look for funding at this stage or deploy some capital into some early stage opportunities. So the first is angel groups. You can find lists of angel groups on Angel Capital Association. There are a ton of angel groups. They are typically structured around regular meetings. Some are more formal, some are more informal. Some have membership fees, some don't. It's typically a place where angels can share deal flow and diligence with one another. And many of them have screening committees that will share the deals that are viable with the rest of the membership. Some expect members to share deal flow, but there's a lot of learning that can go on with these, and there's a lot of nuances between them. I've been listed on the slide. I was a core member at Grubstakes, which is an angel group here in Seattle. And as a core member, I was on their screening committee. So we would review deals on a weekly basis and present those to the broader membership via Teams. I'm also a member of E8, which is another clean tech angel group. And so angel groups can have a specific focus as well, which I think is a thing to think about as you kind of research where you want to get engaged. So they're a great way to dig in as much as you want, I think is how I would phrase those or look at those. Syndicates is another opportunity to invest. And one other thing about angel groups, is that as in the angel groups, you can invest directly many times yourself, or they might form an SPV, so a syndicated vehicle for investment, basically. And so there's opportunities on either of those. And then the syndicates, it's a special purpose vehicle specifically created for investment. And so the diligence has kind of already been done. Somebody's put this opportunity out there and people can come in and invest in it. So you're less engaged in that process. And angel list, you can kind of dig around and see what deals are in there and find opportunities there. And the real benefit of something like that is that you can come in on a pretty low level, like a check size of 1,000 to 5,000. But there are also fees that come alongside that. So keep those things in mind as well. Angel funds, I think everybody's familiar with SAC. So that is definitely, I don't know if would you say everybody's familiar, John or
no, I bet
John or John?
No,
bet not. Do one of you want to give a description of how SAC works?
Sure.
John Dex or John Seacrest?
Yeah. So Seattle Angel Conference is sort of a baby pool for getting into the bigger world of angel investing. We create an SPV each cycle. We take 20 to 40 investors, produce a fund of 100 to 200,000, and then we sort through hopefully 40 to 50 companies. So in APUS, we have a little more than 50 companies involved, and we're starting the process of evaluating those companies in American Idol meets startup format. And then we'll do some due diligence, and we know that good due diligence on a company is important. It increases your success rate significantly. And then we have a big public event at the end where we pick one of the companies to invest in. So it's a little bit slow for many angel founders or startup founders because we take a full 3 months to go through that cycle. And the ones that are moving fast don't have 3 months because they're moving too fast. But nonetheless, it gives people a way to get their act together, get their tightened up on their presentations. And as a result, we have 480 investors who didn't invest before who are investing now, some of which are now professional at it.
Yeah. Yeah, absolutely. So I think, I mean, it's a great opportunity for learning and also for really getting engaged in the network, because I think, you know, through SAC, you see all these, a ton of companies coming through too, right? So you're immediately plugged into that deal flow and just the networking amongst other investors, because it is a good mix of people between experienced and newer to investing. And so I can't say enough good things about it. It's a longer process than would be the typical process. Another fund, I say this is listed as Angel Fund, but is the Sea Change Fund. I'm a member there, an LP there, and it's slightly different, although it is that actively managed format where people who are coming into the fund as LPs do vote, they do due diligence, they sit on the screening committees. So it's a very engaged process, I would say, similar to what SAC provides. But Sea Change, you'll end up with your investment into the fund with a number of investments that come out of it. So it could be up to 10 or 5 to 10 investments. And so there's, you know, some really great benefits to both of those processes, especially if you have the time to commit to learning and get engaged. VC funds, the last thing on the slide, are entities that are organized with a specific investment focus and portfolio strategy. LPs invest a certain amount, and that could range between, you know, 50 to 250K, but it's called across a number of years. So it's not all at once, and then it's professionally invested across a number of companies. So it's a good way to get a broad diversification in your portfolio and doesn't require as much effort on your behalf because you're not actively doing the due diligence yourself. So it's you're handing that off to some professional investors. So, you know, as you think about the facets of diversification, know that all of these things, groups, syndicates, funds, can really be additive. You know, you can join an AngelList syndicate for as little as $1,000. So that means you could do, you know, 25 deals for 25K. Or you could go to, you know, a member managed angel fund and get exposure to another 7 companies. So I think just thinking about that math is important. But in addition to the math, thinking about what each of those groups provide, perspective and expertise. You know, I joined E8 because I worked in clean tech and I have a passion for it, but because the investors in that group are more knowledgeable than I am by far. And they have fellows that work with them. And so there's a lot of this value that group brings to my investing experience. So that's one of the things to kind of consider. Geography and stage, you know, are you hoping to get exposure to a specific region? You know, maybe you can find an angel group that works and they invest only in one region or invest across the US or invest, you know, Latin America or wherever it might be, but just something to consider as you think about it. And then network and access, you know, a lot of people say that they have great deal flow, but what's the quality of the deals that they're seeing? You know, are they able to actually get into those deals? You know, a little bit about, you know, where they're coming from and what their real true access is. And then I think a critical thing, as we've kind of talked about, is involvement, and what type of time commitment are you able to commit to doing this work? Because there are options for everybody. If you don't have a ton of time, there's ways to get engaged, and if you do and you want to do more, there's a lot of opportunities to get more involved. So those are other factors to consider for sure when you're thinking about how to get involved. So we'll dig now into a little bit about, once you've made that leap, or as a founder, kind of try to give you some insight into what investors are looking for. And so just to kind of step back for a moment and remember where we are in that cycle. We're in that kind of early stage, the valley of death. We're in that, we like to say that kind of faith capital stage. So there's still a lot of risk. There's not a ton of value that's been created. You're putting a lot of faith into the CEO and the idea. So we're kind of right in that beginning part. So as we evaluate deals in that phase, one thing that we have done, and I'm sure many of you might consider, is to look at the reasons that startups fail. And this is, the top 20 reasons that startups fail here. So as you start to look at those, you can categorize these. They fall into some different buckets, and that ultimately has provided a good framework for myself to kind of look at what areas I really want to dig into to try and de-risk an investment. Market potential. What could this become? Like, what's the market here? And I think as an angel, it's also, do I care about it? Like, is this something I'm actually passionate about? Because if I'm not passionate about it, I'm probably not going to invest in it personally, unless there's a really great opportunity for return. Team, is this the right team to solve this? And maybe do I have some insights that might be able to help them? Because I think that at that early stage, and founders, be selective about this, but there is an opportunity to leverage your investors and use their insights. So, those are the types of things to think about from both sides. And traction, what have they already accomplished, proven? What's been de-risked for me as I kind of look at this opportunity? And finally, product, is this really something that solves a problem? And have they gone about it in a way that makes sense? So when a founder comes to pitch, what I'm often listening for is whether they understand that kind of risk to value creation spectrum, and whether they have that plan around how they're going to unlock that next kind of milestone or round of funding, because they're typically many times tied together. So we need to, achieve milestone X, and to get there, we need Y people and we need Z capital. We believe it's going to take us W months to get there. And so to fill in that kind of statement, I'm sure as founders in the group, you have to understand what your monthly burn rate is, who do they need to bring on to unlock and build that next part of their business, and how much is that going to cost? I guess the milestones that you need to achieve to unlock that next investable moment. So, do those goals say 1 million in annual recurring revenue unlock funding for the next round of investors? So just thinking about, where do they understand where they are? Do they have the right milestones in place? Are the right goals set? If they've stipulated that they need somebody that's really specialized in something, have they thought about how hard it's going to be to find that talent and how much it's going to cost them? All these assumptions, and trying to understand if you're comfortable with the assumptions that they've made. So ultimately, am I comfortable taking these risks when I think about the investment? Because I don't think there's a single startup I've invested in that hasn't had any sort of a risk, right? So we all know that. Starting a business or investing in one at this stage is there's inherently things that you don't know what will happen. So, and I would say another factor here is that investors all have different risk thresholds. And so what might not be an opportunity for me doesn't mean it's not an opportunity for somebody else. somebody else might have more experience with a model that I'm not as familiar with, or some success metrics that I'm not as comfortable with, they might be more comfortable with. So, just know that because one person isn't comfortable, that doesn't mean that not somebody else isn't. And then get into yes, and this is the one, I'm sure, John, you've got a due diligence workshop somewhere on there, but I just wanted to show kind of a quick overview of a due diligence process. So how does an investor get to yes? And this should be helpful for founders too, just to understand the general flow and things that you have to go through. This is I put this in a way where it's not linear because it gets squished. Sometimes it moves in different ways. And as John alluded to earlier, the time frame for investments is getting shorter and shorter. So, I know at First Row, we try and make decisions on companies within a couple of weeks. So, it's a pretty, that's becoming more standard to have these shorter timeframes. And I think that there's a lot of groups that are trying to think through how they can expedite their processes to meet the needs of what's happening in the market today for early stage investments. But 2 weeks is pretty short, keep in mind. So what typically happens for First Row is that we get an initial inquiry. If we have interest, we might schedule an initial screening call, and Angels would do that as a coffee chat. Probably we do a little bit of research and determine whether we want to take the next step after having that conversation. And then we'll send a document that goes through some Q&A and request any kind of relevant docs from a founder. And then once we get that information back, we'll go back, we'll have a follow-on call, bringing in relevant parties from the team. And then after that stage, we kind of go into the more detail, making sure, checking and verifying your corporate docs, doing some reference checks, and all that. That's kind of the last stage of the process for us. And then we'll come to a decision. And so, I think the great thing about SAC too is if you're a founder going through that process, or Apus Angels, is that you're building up this great deal room and data room that's going to have all the information that people might need to see probably. And I think that's one of the great benefits of being involved. And then this slide is investors say no, far more than yes. And so you're either going to be saying it or hearing it a lot more. And I would say, just try and understand why people are saying no. And as a founder, and don't be pushy about it, but try and see if you can glean as much information as possible. And it's possible that it has nothing to do with your company. It's just that they've been burned on a different deal that might be related to it, or, there's so many reasons why they might not be able to invest or interested in investing. And I think as an investor going into this phase, when you're saying no, just think about, why did I say no? What are the things that triggered me not getting to conviction about this deal? What are the, why did I get to that point? Because it'll help you as you kind of continue to assess other companies. So I think that it's just an important thing to try and gain as much information on either side as possible about. And then this one is more for founders, because investors are doing so much due diligence on you as a founder, but you should absolutely be doing the same thing on the investors. When angels or early stage funds are making an investment in you, they're going to be with you for a period of time, in theory, if you're successful. So try and understand a little bit about them personally. Are they people you want to be working with? And then understand when you're talking about raising a fund around, the decision of their speed and process, the investment size that they typically do, some of these factors just to keep in mind. So be sure you do the due diligence on investors too. And a lot of this information you might be able to find on websites or Crunchbase or PitchBook, but just be sure to dig in and do your own reference checks as well.
Hey, Karen.
Yeah.
Just a quick question. I mean, in all your experience, what are some of the big, big no-nos or the big red flags that you see, common mistakes of folks that are trying to raise either too early, or are red flags that you say they're immediately chopped off, they're not going to get to the next week, the next day? that are really common amongst some of these founders?
Yeah, gosh, what are some red flags? For me, I will say it's typically a team that has no experience in the area that they're trying to build something. I mean, that's for me. Some people might have more comfort in that, but if I see a team that, you know, really hasn't had any experience in it, doesn't have the right connections in that space, but they're trying to build something, it's hard for me to get to conviction around that. And I haven't seen too many of those succeed, unless they brought in somebody later on that might be perfectly aligned with whatever that is that they're trying to build. So that's one thing. Trying to think if there's other great examples of red flags. Completely, I've seen some startups that, you know, financial projections just don't align. There's no roadmap or financial projections that aligns to roadmap and understanding of that mile, you know, this kind of what your journey would be. And I think that to me is an indication that you're not thinking about how you're strategically going to be building your company. So if somebody comes to me and they showed me this roadmap, but the projections don't sync up with it, it's a really big red flag. You know, where's the missing link here? I'd love to hear other people if they have other red flags. Maybe
a couple notes
John, do you have any?
A couple notes in the chat, Karen, around trust.
Yeah.
You know, this is a relationship you're building on both sides. And yeah. I think, you know, just like dating, you know, if something goes wrong on that first date, you know, you're not going to go for a second. And it's an iterative process, but for sure, early red flags that you're not getting truthful responses, I think both sides should walk away. Either side should walk away.
I would, can I make a comment here?
Sure.
I'll give you a couple of structures to think about. Accuracy, consistency in message, and the ability to listen. One of the biggest dangers that I see over 40 years of investing is you meet an investor or you meet a startup and they have complete conviction that they think they're right. Yeah. And if they have no doubt or they're not prepared to question their assumptions, that is a huge red flag. The second component of that is, coachability is a great word for it. The second component I always map out for them is the use of investment dollars. So if you are investing in a company and you ask them how you're going to invest the money, I want a very precise answer. And part of the problem there is to give you an example, this is a real example. A company comes and says, I want to build something across the United States. I go, how much money are you raising? And they go, 3 million. I said, at what value? And I go, how are you going to focus your investment dollars? And they go, no, we're just going to launch across the entire US. And I say, okay, 235 million divided by 3 million. No one will invest, right? So we went back and restructured it because they were coachable. And we said, if you focus that 3 million on Seattle, you'll be successful. And they listened, they took the input, and we all invested $4 million. Right. So that I think a couple of components there that people can think of.
Yeah, I like that. Absolutely. And the trust piece too, critical. Great.
Great, thank you.
So this is really the end of my presentation, frankly. So there's a lot of great resources out there to learn more. I've listed some of them here. Venture Deals does a course as well that I think is sponsored by Kaufman Foundation, and I've participated in that. And it's a really great way to kind of go through deal terms and partner with other individuals that you might not normally partner with. And it's for founders and for investors. So I think really a great program there. Lots of great VC Twitter is pretty amazing. Minda on the First Row team is on there quite a bit. So if you follow her, you'll get some insights from her as well. join Seattle Angel Conference and as either a founder or investor. I think there's some great learnings and plugging you into the community and the network there. So that's kind of the end of what I had today, but I'm happy to answer any other questions, or John, however you want to manage the next portion here.
Yeah, no, if people have questions, I've been putting lots and lots of references, some of which are here. I assume we're going to get the slides and we can post the slides to the meetup group.
Sure, yeah, I'd be happy to show that.
So the key is that people should look at the bottom of the chat and see the 3 little dots and save the chat, and they'll get all of the stuff that I've been putting in there as well. But if you have a question, either raise your hand or put something in the chat and we can dive in.
I'll stop the share so I can actually see people.
Go ahead, Scott.
So let's say, like this is my first startup. What would it be best to work with a first-time angel investor or an angel investor who's invested and had some experience? Or how is the best way to manage that relationship when you have new angel investors so you can continue to provide that comfort and security and communication so that they feel, you know, that continued level of safety and security?
My personal perspective on this, and others might have differing ones, is that the founder needs to be focused on what the founder is focused on, and the angel investor should be providing insights to you. So I would hope that you wouldn't have to do too much hand-holding for an investor. I think, so be careful about that, I would say. I don't think new investors are bad, and I think that you can definitely, the great thing is that they're probably willing to provide more insight and help if you need it, you know, so be thoughtful about who you bring on as an angel investor, because they could help you get to that next phase and they might have the right connections for you. And so leverage that, but you shouldn't have to hopefully not manage their expectations. And you know, I think as angels get more involved with other deals, they become clearer around that, hopefully, but you shouldn't be afraid of them either. So,
right.
But just my insight to you would be, you know, just be thoughtful about who you're bringing on and what you might be able to leverage from that connection point as well.
From my personal experience, I have a deep sincerity not to lose other people's money. I mean, money's hard to come by, and so I have to balance that within myself, because at the end of the day, you know, I'm the one that is either going to succeed or fail in helping these people get a return on their money. So it's nerve-wracking.
I'll make a couple of quick comments here, right? So the first one is this: if you do a startup, the first thing you're going to do is light up Notion. You're going to create a document repository. And the first thing you're going to do is you're going to put all the documents, everything that is super important, all the employee documents, everything in a folder. It's a due diligence folder. Any new contract, anything goes in that from day one. This is the thing that kills everyone. They run around trying to find all the documents. Put all the documents in one place. On feedback to investors, what works for me is this. I write a diary. And what I do is every quarter, I write them one page. Yeah. And they've all got my phone number and they can ring me up. But then what I've done is I have a spreadsheet and I've asked them all as an investor, I say, where are you connected and what are you good at? Right? So all of the people who've invested with me, I have literally a Rolodex and I go, what they're good at, who they know. And it's like this. So real example, this happened this week, right? I'm doing something in healthcare and I go, man, I got to talk to these people. Got a spreadsheet, search spreadsheet. 6 people who are very well connected in this space. I go to LinkedIn, I look at the people there. I ring up one of my investors and go, dude, how you doing? And he goes, Pete, what do you want? I said, I need you to introduce me to this guy and this woman at this company. And he goes, yeah, I'll do it today. He said, can you send me a template? I said, here's the company template. This is the problem we solve. Send this to them and ask them to talk to me. And he goes, it will be done. The only thing he had to do was send the email. I did everything else, right? But the reason he does that, and he's actually made this comment to me, he said, if there's one thing you consistently do every quarter, on the first day of the quarter, I get an email from you on the 4 investments, and I just get the email. And he said, that's why I invest with you.
Yeah.
And I said, it wasn't the photographs. He said, no, that's different. I want those back. But everything else, it's because you send those papers. So,
I think it's absolutely true. And I think as a founder, one of the things that as an investor, I think has been most helpful is to get these regular updates from a company so that I'm not left wondering what's happening, why aren't they doing, what are they doing? And in that, the ones that are most helpful to me is when they say, here's some updates, here's where we did well, here's some things that we didn't do so well on, and here's where we need your help. And they make the asks of the investor. And I think that helps set expectations. It helps you get what you need from those investors as well. So that kind of regular cadence of communication.
Yeah. In project management, staying in touch with your stakeholders on a regular basis and getting engagement and feedback. Well, not always feedback, but keeping them informed and asking for feedback.
They don't run the company. So this is very important. I've done this, and it's been very painful. You're going to get an investor who goes, I put in $1,000. When do I get my money back? And you're going, what? And they go, I put $1,000 in. You owe me $1,000. And like, you'll have someone else who's put in 24 million, and they go, hey, give me an update. So the point is get on the schedule, write the diary, and don't make it work. Because the problem is there's a lot of people, because they don't write everything down. So just get in a model of planned, completed, progressed, escalated. If you think of the business like that, and don't talk about motion, a meeting is motion, the actions coming out of the meeting are the actions. So if you can talk to your investors about all of the actions that you've completed and the actions you're going to take, then they're going to help you.
Yeah.
So I'd like to call on. He's got a question up.
I want to finish this for Scott. Scott, you said that you wanted to worry about the investors and the return on investment. And I have to say that in my experience with running my business, things got weird. Run out of money here, have bad customer there, have stupid employee there, where you get to the end of the day and you're just done. I'm done. I don't want to do this anymore. And because I had taken other people's money, it held me in the business enough for me to calm down enough that I could make the business work, and I exited for positive cash. But that happened because I was trying to manage other people's money, and they had committed to me to help me, and I needed to commit to them to be reasonable about their investment. So it is a heavy weight that you take when you take outside money.
Yeah.
Yeah.
Thank you.
Elizabeth, you were going to introduce someone.
An has a question that I'd like to make sure he gets answered. He's been raising his hand here.
Thank you, Elizabeth. So I wanted to, it's slightly pivoting, so that's why I wanted to wait till the discussion kind of dies down here. I wanted to focus on the top of the funnel. It's all great to have a bunch of companies and do the due diligence and figure out, all the great pieces that you've talked about. But with accelerators, angels, all sorts of funds popping up all over the country, how do you make sure that you are getting the right input of people coming into your portfolio that you can invest in and be successful?
So how do you get the right deals, or how do you get the right people to invest in those deals?
Well, how do you get the right people that you want to invest in? If you, if you turn the table just slightly for a minute, if you are seeking investment, you've got, all the way from Y Combinator to VCs. And I understand it depends on a lot of things, your geography, your area of focus, your product market fit, the stage you're at. But even within those verticals or within those areas, you have so many options. How do you, as an angel investor, ensure that you are getting the best input of people wanting your money, so that you can get to the ones that are the lowest risk for you or the most interest?
I think, well, if I'm understanding the question correctly, but I think it's about doing your own due diligence on all of those groups, right? And understanding all those factors that we've talked about. And again, I think finding the deals, the network, and the access that each of those specific groups has, and understanding where they get their deals from, how they source it, talking to other members that have been engaged in it, you get a real sense. You can have a few conversations with a couple people that have been engaged with some of these groups and get a feel for how those, whatever it is, works, whether it's a angel group or a fund, or and a lot of these have a lot of detail they could share with you. How many companies they've invested in, what across what sectors, most of them will have something they can share with you, so that you feel like you're getting the right access to the right deals that you will have confidence in. Again, you don't have to invest in something. If you're in an angel group, you don't have to invest in it. Now, I don't know if I answered your question specifically.
I think you're asking a little bit broader question about how do you get deal flow, right? Like what's coming towards you. And so I think, to Karen's answer, one of those is through angel groups. One of those is through participating in some of the early other parts of the ecosystem. So like UW competitions, right? Those companies are often too early for a deal, but you go and you volunteer as a judge at the competition, you get to talk to some of the other judges, you kind of build those relationships, you follow those companies, and a year or two later, when they are at the point of looking for angel money, they already know you. So some of it is also just kind of becoming known in the sector. And this is where I do think, Karen was talking earlier about diversifying, having been on both sides of this a little bit. It's super helpful for founders if you build a reputation in a specific sector or a specific stage. And that's not to say you're not investing elsewhere, but kind of building that brand of, oh, you do, healthcare SaaS. Okay, great. Anytime I meet a founder that's doing healthcare SaaS, I'm going to say, hey, do you want to meet? Or, whatever that looks like. So starting to build that. And then I would also say there have been a lot of people who've been building that brand on Twitter. Following people who are already more well-known angels, and then just direct messaging people when they try and pitch that more well-known angel, and kind of saying, hey, I'm interested in this space too, let's talk. So the groups are definitely an area for kind of the local community, but there's been a lot that's been happening virtually, especially in the last couple of years, where getting involved in the spaces you're interested in, you can see kind of who's working on what.
Can I add a comment? So I'll tell you what I do. I have a notebook. It's electronic. When I go into a space, I identify 20 or 30 people who are talking about or writing about or thinking about that space. And then what I do is I find and John will tell you that I read a lot because I have no social skills. I then get 5 or 6 key books, and I read up in detail on the subject. And at that point, I have 2 flows. I have a group of people who are thinking about the subject, and then I try and become educated, and then I merge the 2, because I'm looking at what they're talking about. And the thing I look at to seek companies is replicatable problems. So if I see someone who's consistently got the same problem, and I can see that occurring across an industry scape, that's an area I'd probably be interested in as an investor, or as someone who solves the problem, or find someone to solve the problem and invest in them to do the work because I'm lazy, right? And so if you have that model, that becomes very powerful, because then what you end up doing is you start seeing, the thing you're really looking for is the problems, not the solutions. You're looking for the problems. And if the problem is replicatable, then you can find the people who are talking about it, and that will lead you to the deal flow. And actually, what I end up doing then is ringing up the people who are talking about the problem, make friends with them, because I can talk reasonably well about the subject. And then if we see something that's interesting in that area, we'll go look at it and we may invest. And then over time, people start ringing you up. Now, at the start, it's great because someone rings you up and you go, that's awesome. But at the end of it, you're going, will you please stop ringing me? And that's not a joke. I mean, some people are like serial killers. But if you try that model, it's not rocket science. It's pretty simple, but it's very effective because then you get into the flow. And I think that Caitlin's comment was really important. Find people you think are in that area.
So this highlights the importance of founders having a content strategy before they build their product. Because when Pete is looking for people talking about the problem, he's hoping that the people talking about the problem are the ones that are thinking about how to solve the problem. And if you're all stealth and quiet and not talking about your product, you are unfindable in that space. And so for startups, you should be doing a content strategy that explores how you build reputation as someone who is trying to solve this problem, or at least clear and aware enough of the problem to tell you what the existing alternatives are and why they suck. And if you can't do that for yourself as a founder, you're going to have trouble doing that for your business when you need to build the deal flow.
Yeah. And just to double down on a lot of that, I mean, I think it's all about the trusted networks that you build. There's a lot of, I would say, I don't know what percentage of deals that I've invested in have come through like somebody sharing a deal with me because they know that I'm interested in a particular space, or they know I have some expertise or insight in the space. But it's higher than the ones I find on Twitter. But Twitter is a great resource, I would agree, and it's growing. I think the opportunities there. So it's good to be lurking in the sidelines to look for opportunities in a lot of different places. But it's about building the network and once people building your own reputation as an investor too, and starting to have people know you and what you invest in.
Karen, could I ask, since you've had this experience across all these different spaces, what did you learn differently investing as an individual versus investing in a group versus being an LP in a fund? Kind of for your personal learning and growth, kind of what are those different experiences what are you getting out of it in addition to deal flow and the financial returns and all that, but in terms of learning and growing as an angel?
Yeah, I mean, I think this starting again was pretty much with SAC and with my business school program, but and so understanding the basics through that process was pretty critical. I think then participating in some of the like the venture deals program to get a better feel for term sheets and, so I think that there was like a learning process about the structures and organizations and processes and deal flow that I really gained from a lot of that program. And then I kind of moved into, okay, well, how do I really look at a company? And you do a lot of that at SAC, but I think drilling in with something like the Sea Change Fund, where you're kind of actively engaging in regular discussions about specific deals and going through, you can participate in the diligence process. It was really getting really much deeper on a greater level, I would say. And so that's kind of all cued me up into where I am today in terms of, doing that on a very regular basis and trying to fine tune my skills of what I'm comfortable with. Because I think when I first started digging into companies, I would spend a lot more time on a company, trying to understand all the nuances. And now I kind of understand, what are the things that I specifically look for? What indicators am I, really go, no go for me? And so I think over time, as I've kind of honed that skill, and that's where now it's more about the community and the network and the people I'm working with. I'm pretty lucky to be working with a couple other female investors. And so, I feel fortunate to be surrounded by some great people and being much more engaged in the space and much more, doing opportunities like this where I get to connect with big groups of people that represent all sorts of parts of the ecosystem. So it's been an evolution and learning and every stage has had a different learning, but the same learnings, so it's tough to kind of fine tune, but I've definitely kind of honed in on a lot of my, the things that I'm looking for as I go through each stage of these things. So. And everyone has been, you know, and again, today I'm still a member of E8 because I'm still super passionate about clean tech, and I love what they bring to the table, and I'm still participating in Sea Change, and I'm still, you know, a LP at First Row and a partner there, and so I've just had the opportunity to meet some amazing people through all of these parts of the journey, and it's fun to look at this group of people here and see a lot of familiar faces from different stages of that journey, which is not that long. I've only, you know, been at this for a few years, so.
So as a E8 member, are you going to the workshop about success going public journeys that's coming up?
You know, it just happened. It was at the same time as this event. So
go look it up.
Mike emailed me and I was like, hopefully he'll record it, because I think that will be a fun one, because they've had a couple good exits lately.
The ESS company was a SAC investment for SAC 6. And now it's public on the New York Stock Exchange. So that's what they were talking about today. And I'm sorry that it was at the same time, but hopefully we can get a recording. If you find the recording, I would love to see it.
Yeah, I'll be sure to share it if I can track it down. I'm sure they should post it probably.
Cool. Are there any other questions or commentary? I see that we had a couple new people come in. So if you have something you want to say, now's a good time to say it. Steve wants the chat exported. We'll do that for you, Steve.
Thanks, John. John, I just want to thank you. I'm getting reconnected back into your community here after being gone a couple of years. This forum is amazing. It blows my mind how active you've been, and the quality of people you attract, and looking to get back into the flow and meeting some of the folks here.
Thanks so very much. Yeah, we're picking up steam with a European one and a health one right now. So even more busyness to be involved in. So what
is the next round of SAC, John?
SAC 21 is the deadline for company supply is February 24th, and we'll start with the angels in March 1st. We're deciding the health angels tonight. We'll pick the quarterfinalists. So that'll be good. And our European one likely is late in the spring. We haven't quite nailed down the foundation yet, but we're working on it. So,
and Elizabeth, will you tease some of those quarterfinalists on LinkedIn or somewhere? Are we going to get a sneak peek ever?
I have put a couple of them out there, and I'm ready to put a few more. We just got some patent announcements from some people right on this call today. So we're teasing them out as we go.
Perfect.
Yeah, I put the Twitter addresses that we use. I didn't put the Health Angel one in there. I'll add that one. And we've been putting them up on Twitter and as well as in our LinkedIn. Any other questions or thoughts? Aaron, would you mind me picking on you and just asking you a very quick question? How do you think differently about investments globally than locally? I know that you are the most global investor I know of.
Yeah, bear with me. I'm actually driving back from San Francisco to San Jose, where I just attended a meeting with a group of international investors. It's to answer the question, you know, as you know, John, when I look at a company, you know, in Seattle or Portland or, you know, Mountain View, California, I do look at what's the international markets right away. You know, globalization may be a negative term in the geopolitical space, but we do live in a globalized world. And, you know, when I look at a map, I've got a map of the world on my wall in my office, and, you know, you look at these high growth markets, Southeast Asia, South Asia, Middle East, and there's been a lot of buzz about Africa. And anyone who reads The Economist, this current issue has an amazing article about Latin America. or they start a market. A lot of buzz has been about Africa, but Latin America is still, I think, 5 times the size of Africa. And Latin America also has a more robust public equity market that Africa still really doesn't have yet. So that's one aspect. I was at CES a couple of weeks ago, and then I'm going to Mobile World Congress in Barcelona next month. And John, I know you've been engaged more in Europe, and it's the thing. It's looking at geographies more generally and thinking early in the business strategy of how to access these type of markets. Lots of risk, of course, but I think with digital and technology, it's much easier to access some of these foreign markets relatively soon in the startup life cycle.
Yeah, absolutely. Thank you so very much. I appreciate your moment of driving. That was great. So Karen, do you have any requests of people? We have still 40 some people on the call. Anything they can do that will be helpful?
For me, yeah. Well, if you want to learn more, I'm always happy to connect. So please connect with me on LinkedIn or just chat or send me opportunities. And if there's anybody you think would be a good fit for First Row or through an angel group, please let me know. I'm happy to help make connections, or I'm obviously more than happy to extend help to people through my network as well. So yeah, just keep connected and keep doing what you're doing on both sides. I think it's a growing network, and thanks to John a lot for putting so much effort into building up this kind of early stage ecosystem all over the world, apparently. So
hey, John, I do have a question before we kind of dismember here,
go.
I'm going through a formation right now. I'm in the Seattle area. I'm just wondering from the investors' perspectives here, is a company formed in Delaware more attractive to a company formed in Washington State?
Are you planning to take venture dollars?
Yes.
So it's definitely more attractive to venture capitalists. And most of the venture capitalists you're going to talk to are not in Seattle. And so Seattle angel investors don't care really whether it's Washington or Delaware, but the Series A people probably do.
So the Series A is a bit iffy. I know I want to go through, a couple of Series A rounds. I might bootstrap. I think it's $1 billion business that could survive without a Series A.
So then it probably doesn't matter. Do what's simple and easy for you, and then when you get forced into the corner about it, you can convert to a Delaware when you want.
Hold on. I'm going to give you. I'm going to add to this.
Pete, I was hoping you would chime in because.
So look, I don't invest in LLCs, and the other thing you got to look at is Canadians can't invest in LLCs at all. I have divested all my LLCs when I immigrated to Canada, gone, and my tax accountant, my finance guy all said get rid of them.
Yeah. Right? So just to be clear, none of the angel groups in Seattle will invest in anything but a C Corp or a B Corp.
Yeah, I'm just asking a C Corp in Washington State versus a C Corp in Delaware. Maybe Pete, from your perspective.
And also just keep in mind, you may not only be talking to Seattle angels. So if you're talking to an angel group in Arizona or an angel group in Virginia or whatever, which is happening a lot more now with Zoom, even though Washington C Corps and Delaware C Corps are a lot more similar than they used to be, they're just not going to be familiar with that. So that may also be something to be.
It's way simpler than that, right? Is they won't invest. Here's why, and it's a very simple reason for it, is if someone comes to me with a Delaware C Corp, all my lawyer fees, everything, I totally understand them. Yeah, I know exactly how much I'm going to pay. I know what it's going to cost, everything. If you turn up with some random state company, something like that, I'm going to turn around to you and go, that's really nice. Ring me when it's a Delaware C Corp. I won't ring you. You ring me when you've done it, right? And the reason is, if you're an LLC or anything like this, or any other widget, right, you're making my life complex. And the famous story is this is the way as I describe it. Investors have a lot of money and no time. Startup people have no money and a lot of time. It's a perfect match, right? But if you start messing with my time, I'll turn you off. And that's not because I don't like people. It's just that I don't have any time, right? So the thing is as long as you think that way, that's why when you go to talk to investors, they're going, well, can you be quick? It's because, and this is the empathy thing, I get 60 to 70 outreaches a week, if not more. Yeah. You know how many I respond to? Got a number? 5. 10 to 5, maybe 5. I'll go, okay, I'll take the meeting. The rest of them, I go, sorry. Because this goes back to what I said earlier. I have an investment focus. I'm looking for companies that have certain keywords or certain problems. If they tell me that they're working in this space with this problem, with this area, I'm going to ring them. They're not going to ring me. Yeah. And that goes to Anne's point, right? Which is I'm looking, they're trying to find me. It's easy to find me. It's difficult to find them because if they're in stealth mode, I can't find them. So what's going to happen? I'm going to get introduced through a friend, right? So it's either social network or you send me a short note going, I'm working in this area. And I go, okay, I want to talk to you. That's it. Does that help?
It totally does. Thank you so much.
If I can add one piece of advice, because I just gave this to someone recently with this question who's in Seattle. My thing was that if your business scales, if it grows, you're going to be filing multiple amendments to your articles of incorporation. So to start off with, and I agree, ultimately I agree with John where it really doesn't matter, but what Pete and others have said, the advice I give is incorporate in Delaware, just 100 shares, absolutely minimum incorporation, get the name, build it, do the trade name registration as well. That way you have it at a minimum. Your expenses for a registered agent is minimal through CT Corp or someone else in Delaware. If you're using a Washington address, you're going to need to register as a foreign corp in Olympia, which is going to be the same charge as if you're doing a domestic corp anyway. And then, because again, if your business grows, you're going to be filing, amended articles of incorporation. That's going to increase the stock, the preferred, and the common, or if you have, different series of stock, but at least you've started the first step in Delaware.
Yeah, one thing I would add to this, right? I mean, this is a minor point, but it's important. I get a lot of people to me say, I want to be a startup. And so my first company was second company was a cleaning company. I'm from Cleantech. And that company's still running, right? That was never a startup. It's not a startup. It has no profile of a startup, never be a startup. It employs 400 people, right? We clean buildings, yeah? But the point being is, that's a really good business. You just never tell anyone you make any money because you don't want anyone else doing it. Yeah. And so the key thing is, if you make a decision that it's not a startup and it's a company that you want to run, do that. But then if you make that decision, it's good. The thing is, a startup is a company that has a profile of excessive growth. Yeah. With a simple transaction that someone looks at and goes, yeah, that could be $100 million business. Yeah. So the thing you want to look at, probably the most important thing to look at when you're starting a company is how long does it take to do a single transaction? How many people are involved? Because as soon as you look at that, this is what I do. When a company rings me up, I just go, tell me about the sales flow. And they go, what do you mean? I said, how long does it take? And they go, what do you mean? I say, okay, one salesperson, how many can they sell in a year? And they go, 12. I say, okay, what is their conversion rate? They go, 10%. I said, okay, in order to make 1.4 million, this is how many salespeople you need with this failure rate. It's really simple math, right? But when you do that, right, I can filter a company on that 3 questions, because I just go to them and say, how long's the sales cycle? How much do you make on the sales cycle? And what's your failure rate? And from that, I can calculate the number of salespeople they need to scale the business. And if the transaction volume is too low or too complex, I'm not going to invest. That is it.
Yeah, but you're talking about post product market fit. And so,
that's a good point, John. I totally agree with you. But my point is if someone's doing a startup and they start thinking about that problem of, I can sell this widget in this amount of time for this return, then what they end up doing is going, okay, that means I could make $1 million with one salesperson with this margin, and I could pay that. That very simple math is a really good place to start, at least in my opinion, because if you have those even guesses, yeah, it really helps you think about the fullness of the business.
Yeah. This is going back to the earlier question of what are the red flags? So as an investor, one of the red flags is, I don't know what my sales cycle is. I can't predict my cost of customer acquisition. I don't know how many salespeople I need to be cash flow positive. And so I haven't really done my financial discipline, which is sort of one of the top 6 risks, I think, in a startup. So, and any other thoughts or contributions from people before we call this good? All right. So, go ahead, Scott.
I have a quick question. So in terms of 2022 and the expected sort of downturn in the U.S. market, with inflation and quantitative easing changing and the Fed raising rates, how does that impact the availability or the number of angel investors that are entering the market? Or what do you see the impact of economic shifts and the impact on angel investors?
Well, I think probably the biggest thing that makes a difference on angels is what the stock market indexes are. And so people feel wealthy when they have a lot of numbers on their stock market index, and when they lose a bunch off of it, then they feel less wealthy, and they hone in a little bit. But good angel investors are trying to buy in the dip. And so when the stock market goes down, that's a great time to angel invest. And so the good angel investors, the ones that you want, are writing checks in an active way, even when that happens. So for the most part, I don't think it's a problem for good companies to get funding no matter when. Maybe a couple of months in 2008 kind of thing. But I don't think there's a problem. But the hard part is having a good company and understanding your fundamentals and knowing your customer costs and sales cycle and all of that stuff. And so that makes a difference.
If I can add to that, because I follow this pretty closely, I agree with John. I think particularly technology, in the technology sector, you're going to see a lot more angel investing in the US. And because the tech sector on the public equities, that's the growth sector. It's going to be a tough year for growth stocks. Growth stocks increase because of their dependence on cheap loans from the banks. And when the Fed starts increasing their rates, most likely in March, 3 to 4 times, that's going to take a toll on the balance sheets of some of these really big tech companies. And so you're going to see more of a shift. Buying on the dip is always happening, but you're going to see more of a shift to private markets, to private capital in angel investing. So I do think I'm very bullish on angel funding and Series A funding in the U.S. Tech sector for 2022 and going into 2023.
Yeah, I would agree. I have put, again, our Meet the Funders panel that we're doing next week. Several of the angel groups in town are going to come and talk. I would invite you all to come to that. I think it'll be an interesting conversation. We're going to use Remo so that we can do breakout rooms really easily. So please share with your friends. Anybody who might become an angel investor or anyone who might take outside money might find that useful. Thank you so much for coming and doing this presentation, Karen. It was wonderful to have you as a speaker. We look forward to having that conversation expanding in the future. And I know that you do some interesting workshops as well. So be sure to share those with Elizabeth and I, and we'll put them down our social media channels.
Yeah, exactly. Yep. Please stay tuned for First Row events. We'd love to have you all participate. So
yeah, thank you.
Thank you.
Great to have you all here.
Thank you, everyone.
Bye-bye, everyone.